After years of little inflation, countries are currently facing the highest period of inflation in decades. Investors are also hearing increased chatter about a recession. As volatility and uncertainty grows in global markets, more investors are turning to uncorrelated assets to generate yield and diversify against worst-case scenarios. In the US, inflation is currently higher than at any time since 1981. At the same time, indicators like the yield curve have analysts talking about a possible recession or the possibility that we're already in one. In economic terms, we're technically in one already, given the negative GDP growth over the last few quarters. Though the last flash recession was during the start of the recent pandemic, the 2008 to 2009 recession is the one we still talk about today, as its lasting effects are still being felt. Private credit investments existed during past financial crises, yet they were only available as funds, or for institutions, or for those privileged enough to have access to deal flow. As public markets fell, investment firms and their high-profile clients turned to assets like private credit to divest away from market volatility. They did this because private credit operates largely separate from public markets. Even in recessionary and inflationary environments, there will always be demand for private credit and high-yield transactions for investors. By investing in private credit, you may be able to find asset classes that are largely decoupled from stock market performance, while getting access to floating rate investments where yield increases in lockstep as rates increase as well. Underlying assets in a debt agreement, of course, could have some exposure to public markets. That said, how private debt moves and changes in price is often not based on market conditions, but based on factors like risk, collateral, cash flow, and other qualities unique to an investment opportunity and removed from the movements in public markets. In the end, with private credit, you have an investment with the potential to generate high yields across short durations, even during all this uncertainty. And as the platform powering the future of private credit, Percent is here to help investors weather any storms ahead.